You're probably feeling overwhelmed watching the news about inflation, rising interest rates, and global tensions. Ray Dalio felt the same way in 1982 when his hedge fund nearly went bankrupt. He built Bridgewater Associates into the world's largest hedge fund, managing $150 billion at its peak. But that success came after he lost everything and had to borrow $4,000 from his father just to survive. That failure taught him to identify the 5 forces that drive every economic cycle. Today, he's using this knowledge to warn investors about unprecedented risks ahead. By the end of this video, you'll understand Dalio's 5 forces, why they matter to Canadian real estate investors, and 3 practical steps to increase flexibility and protect your capital. What he discovered about market crashes will change how you think about investing. Please review the reference in the description below. I am Kane. I own several properties throughout Ontario. Watch my biography video for my full story. Without further ado, let's begin. Dalio studied 500 years of economic history and found something remarkable. Economic disasters don't happen randomly. They follow predictable patterns that repeat about every 80 years. He identified 5 specific forces that create these cycles. Each force builds pressure over decades. When they combine, they create massive shifts in wealth. The pattern is always the same. First comes prosperity, then comes the crisis, finally comes the reset. Here's what makes today different. All 5 forces are active at the same time. This hasn't happened since the 1940s. Back then, we had World War II, massive debt, political upheaval, and technological change. Today we're seeing the same combination building again. The first force is money and debt crisis. Credit creates economic booms, but later squeezes when debt becomes unsustainable relative to income. Dalio flags the UK as having serious fiscal and debt problems and a diminished capital market role compared with the US. When currencies weaken, it reduces purchasing power, a dynamic Dalio highlights in his analysis of debt-driven crises. The second force is internal political conflict. Dalio emphasizes widening wealth and opportunity gaps as a driver of internal political conflict. This gap creates political instability between left and right, breeding distrust in systems. Governments change policies frequently, tax laws shift, regulations multiply, investment rules become unpredictable. When politics become unstable, markets follow. The third force involves geopolitical tensions. Rising powers challenge the existing world order. Geopolitical tensions and supply chain shifts affect trade and energy costs, which Dalio cites as part of the geopolitical force. This creates inflation and reduces economic efficiency. Trade wars hurt everyone's purchasing power. The fourth force covers acts of nature. Dalio notes that droughts, floods, and pandemics have killed more people than wars historically. The 1815 volcanic eruption caused global famine. Crops failed worldwide. Entire economies collapsed. Today we see similar patterns. Climate events reshape where people live and work. Insurance companies raise rates. Property values shift in high-risk areas. The fifth force is technology and human inventiveness. Technology raises living standards but creates winner-take-all dynamics and geopolitical competition. The United States and China compete for technological dominance. AI eliminates middle-class jobs. Truck drivers, accountants, and customer service workers face replacement. This creates a winner-take-all economy where most people fall behind. Each force is powerful alone, but when they combine, they create perfect storms. The money crisis makes governments desperate. Political conflict prevents effective solutions. Geopolitical tensions disrupt trade. Natural disasters strain resources. Technology changes eliminate traditional jobs. Together, these forces destroy old economic structures. The 80-year cycle means we're approaching a major transition. The last reset happened in the 1940s. Before that came the 1860s crisis, and before that, the 1780s upheaval. Each time brought massive change, but also massive opportunity for prepared investors. Understanding this cycle gives you an advantage. You can prepare while others react. You can position yourself before the changes happen. Historical cycles transfer wealth to those who recognize the patterns. Local concentration increases risk during big transitions. We're currently in the build-up phase. The forces are gathering strength. Most people don't see the connections. They focus on individual problems without understanding the bigger pattern. This creates opportunity for those who recognize what's coming. What does this mean for you as a potential investor in Canada? When these 5 forces align, they create massive wealth transfers. The question becomes how to position yourself on the winning side. After his devastating 1982 failure, Dalio developed a specific approach to navigate these transitions. He calls this approach the smart rabbit strategy, based on an old Chinese proverb. A smart rabbit has 3 holes. For investors, these 3 holes represent your escape routes during economic cycles. The first hole is mobility, your ability to move investments across different countries and regions. The second hole is liquidity, having cash and assets you can sell quickly when opportunities appear. The third hole is knowledge, using technology and systems to identify opportunities others miss. Dalio warns that being financially nailed down to one location limits your mobility when big cycles shift. History shows local concentrations can be damaged during major cycles. When economic forces align, they don't affect all regions equally. Some countries handle debt crises better than others. Some currencies stay stronger during geopolitical tensions. Some markets recover faster from natural disasters. Geographic diversification protects you from these local risks. You can buy US stocks through your Canadian broker. You can invest in international funds with small amounts of money. One can also invest in private equity and international businesses. These options give you exposure to multiple economies without leaving Canada. Dalio recommends US investments over UK or European markets for specific reasons. The US has deeper capital markets with more investment options. American companies raise money more easily than European ones. The US venture capital system creates more innovative companies. These advantages compound over time during economic cycles. US stock markets represent 60% of global market value. UK markets represent just 4%. European markets total 15%. When you need to sell investments quickly, larger markets provide more buyers. This liquidity becomes crucial when cycles shift and you need to move capital fast. Financial flexibility requires avoiding investments you can't sell easily. Real estate takes months to sell in good markets. During bad markets, properties sit unsold for years. Private equity funds lock up your money for 5 to 10 years. These illiquid investments trap your capital when cycles change. Building cash reserves gives you power during market shifts. Most investors keep only enough cash for emergencies. Smart rabbit investors keep meaningful cash reserves for opportunities. This seems conservative until markets crash and cash becomes extremely valuable. When opportunities appear, cash lets you act while others can't. You can buy assets at discounted prices. You can invest in new opportunities others can't afford. You can wait for better deals while others sell at losses. Cash provides options during uncertain times. Examples of smart rabbit moves include keeping some liquidity for opportunity instead of locking all capital in illiquid, local-only assets. Consider access to foreign capital markets through your Canadian broker. Avoid concentrating everything in your home city or province. Build financial strength through disciplined earning, spending, and saving habits. Technology now gives small investors advantages that only hedge funds had before. You can access global markets through online platforms. You can get real-time data on international investments. You can automate investment strategies using simple software tools. These capabilities level the playing field between individual investors and institutions. Smartphone apps let you trade international stocks instantly. Online platforms show you market data from around the world. Investment software can alert you to opportunities in different countries. You can monitor global economic indicators that affect your investments. This technology costs almost nothing compared to hiring professional managers. The Smart Rabbit strategy works because it prepares you for multiple outcomes. If Canada's economy struggles, your US investments can still grow. If North American markets fall, your international holdings provide protection. If traditional investments fail, your cash reserves let you try new approaches. This approach requires discipline during good times. When Canadian real estate prices rise quickly, you feel pressure to concentrate more money locally. When technology stocks surge, you want to put everything in one sector. The Smart Rabbit strategy forces you to resist these urges and maintain your 3 holes. But technology offers more than just access to global markets. Dalio sees something bigger happening with artificial intelligence and automation that most investors are missing completely. While everyone talks about buying AI stocks, Dalio's approach to technology investing focuses on something more powerful. He uses technology as a way to improve decision-making across all assets. He built computerized decision rules and back-tested them against historical data. That's the strategic advantage, not just owning tech stocks. Dalio describes his process like building a computer chess game. He defines specific criteria for investment decisions, then codes these rules into systems that can be tested and refined. This approach removes emotion from investing and creates consistent results across different market conditions. Most investors think the biggest technology opportunity means buying tech funds or AI companies. They're missing the real advantage. The biggest opportunity comes from using technology to make better decisions across all your holdings. You can remove emotional interference from your investment process. Dalio argues that today's technology lets smaller investors access data and automated decision frameworks that used to be the domain of large funds. You can now use available market data, automate repetitive analysis, and systematize rules to remove emotion from your decisions. This levels the playing field between individual investors and institutions. Once you have clear criteria, technology can help you monitor these conditions automatically. Your broker likely offers price alerts and market screening tools. Many platforms provide economic data that was once expensive to access. Investment apps can track multiple markets and alert you when your criteria are met. The winners of the technology race will dominate the next economic cycle because they can process information faster and make decisions more consistently. They identify opportunities earlier and avoid risks that others miss. They adapt to changing conditions without emotional interference. The focus should be on technology as a decision-making tool that increases consistency and removes emotion. Don't expect AI to predict mortgage rates perfectly or guarantee investment success. Instead, use technology to execute your strategy more systematically and catch opportunities you might otherwise miss. Advanced investors can model different economic scenarios and stress test their portfolios against historical market crashes. They can simulate how interest rate changes affect their cash flow. They can automate rebalancing when allocations drift from targets. These capabilities were once exclusive to hedge funds, but are now accessible to individual investors. The real value comes from building systems that work across different market conditions. Technology helps you stick to your strategy when emotions run high. It helps you spot patterns you might miss through manual analysis. It helps you act on opportunities before they become obvious to everyone else. But having the right tools and systems only matters if you know how to use them when economic cycles shift. The preparation you make now will determine whether you benefit from the changes ahead or get caught unprepared. 3 specific steps will help you apply what Dalio learned. First, pick one of Dalio's 5 forces to monitor this month. Choose a data point or news source you'll watch regularly. This creates a habit of observing systemic change. Second, identify one smart rabbit move you can implement to increase flexibility. Add liquidity to your portfolio, reduce illiquid holdings, or research options to move capital when needed. Third, choose one simple technology improvement to systematize a decision. Document a rule you use to buy or sell investments and set up an alert to monitor it. Dalio's core lesson from 1982 is not perfect prediction, but building systems and flexibility that survive when you're wrong. Pain plus reflection equals progress. Which of Dalio's 5 forces do you think matters most for Canadian real estate and why? If you like this sort of content, be sure to watch the next video, What the Rich Creates Instead of Buying Real Estate.